What's the bid? What's the ask? What's the spread? I'm going to tell you. Let's go. All right, so two of the most important parts of options trading are knowing what an option should sell for and then also getting it for what it's worth. In order to do that, you'll need to understand the bid, the ask, and the spread. So here we go. The bid price is what the market makers are willing to buy an option for. And the market makers are the floor traders who are buying and selling and setting the prices for all of this.
I have absolute power.
Again, the market makers are the floor traders who are buying an option at the bid and they're selling it at the ask. So the ask price, that's the price that the market makers are willing to sell an option for. And then the spread is simply the difference between the bid price and the ask price.
This is making a lot of sense.
Okay, that spread, that's where the market makers make their money. So let's say that they buy 500 options for $1, and then they turn around and then they sell those same 500 options for $1.20. Okay, the spread is 20 cents, and that's about $20 per contract. When you multiply that by 500 contracts, they end up making $10,000 in just that one trade. All right, that's how the market makers make a living.
See, money doesn't just buy you a better life, better food, better cars, better pussy. It also makes you a better person.
And that's where you come in, because you can limit their advantage with just a little insider knowledge. So for example, let's say shares in ABC company are trading for $15.15, and you want to buy call options. You think it's going to go up in price. You pull up the calls, and here's what you see. You see a bid of 40 cents. You see an ask of 55 cents. And then you see that the last trade was executed at 55 cents. Okay, now here's why 90% of option traders lose money. A rookie looks at those numbers and then immediately pays the 55-cent ask for that option. But here's the secret. Since that option is really only worth the bid price, they're already down 37% before the trade has even started. So here's the pro tip. Never pay the ask price. Always try to split the difference to eliminate the market maker's edge, which is their spread.
You need to get rid of it and get rid of it fast.
So in this case, start off by throwing a bid at 45 cents and see if they bite. If they don't bite, okay, then fine. Up your price to 50 cents. And here's the secret. Most of the time, you will get filled in the median price without paying the full ask price. So as a trading hack for beginners, when you make your first options trade, you want to buy to open. And then when it's time to sell that option, you want to sell to close. Now, buy to open, that means you've just entered a new or opening contract on a call or put option. So sell to close means that you're selling or closing your existing call or put position, hopefully for a profit. And there you go. There's your basic AF beginner's guide to trading on the bid, the ask, and the spread. If you like this training video and you'd like even more beginner's tips, I'm willing to give you my full report totally free. Just click that button below and I will fire you over a copy immediately.